Accounting equation and Excel. Bank reconciliation month 1, part number 3. Get ready and some coffee because we're about to learn the accounting foundation, the accounting equation using Excel. Here we are in Excel. First, a word from our sponsor. Yeah, actually, we're sponsoring ourselves on this one because apparently the merchandisers, they don't want to be seen with us. But that's okay, whatever. Because our merchandise is better than their stupid stuff anyways. Like our Trust Me, I'm an accountant product line. Yeah, it's paramount that you let people know that you're an accountant. Because apparently we're among the only ones equipped with the number crunching skills to answer society's current deep, complex, and nuanced questions. If you would like a commercial-free experience, consider subscribing to our website at accountinginstruction.com or accountinginstruction.thinkific.com. Well, if you don't have access to this workbook, that's okay because we basically built this from a blank worksheet but started in a prior presentation. So if you want to build this entire worksheet from a blank sheet, you could begin back there or just construct your own worksheet as we go, or possibly just follow along with good old paper and pencil. If you do have access to this workbook, though, 4 tabs down below: example, month 1, practice, month 2, example, in essence, the answer key. Month 1, prior month of operations, the practice tab having pre-formatted cells so you can practice the practice problem with less Excel formatting. Month 2 tab, the one we will be working in, current month of operations, where we started with a blank worksheet but are basically working within a template now. However, we will be adding to that template as needed as we go, practicing our Excel tools and formatting as we do so. Let's go to the example tab to get an idea of what we will be doing. Remembering we're basically building our bookkeeping system based on the accounting equation, it acting as our trial balance from which we have constructed our financial statements, that being the balance sheet, income statement, statement of equity. We're now looking at the bank reconciliation process, doing it in a more manual fashion in our, what I would call our 2-dimensional type worksheet, keeping in mind how we might do it if we had what I would call like a 3-dimensional type database program, such as a QuickBooks or a Xero, remembering that the general concept is you're gonna need to do the bank reconciliations. I don't care if you're a small business, a large business, I don't care if you use bank feeds to create your books or not. Do you have accrual components or are you on a cash-based system? You're gonna wanna do the bank reconciliations because it's gonna be a huge internal control, only second to the double entry accounting system itself. Even with the technology, it's still necessary, although some businesses will be a lot easier to do the bank reconciliations than others. Those are some of the things we want to keep in mind as we are exploring the topic. So we've basically done the bank reconciliation now, and we've noted that there were a couple items on the bank statement that were not on our books. In particular, these items. So the general rule will be, if there's something on the bank statement that's not on our books, we're going to have to record it on our books, unless the bank is wrong, in which case we're going to have to go to the bank and tell them to fix it. But that's not usually the case, right? We're going to go, yeah, we probably do have those items. They charged us the bank service charge. Okay, we're going to have to deal with that. So we're going to have to record it on our side of the system. If there's something, however, that's on our side that the bank does not have, that might be that the bank is wrong and we are correct. Now, it's not that the bank made an error, it's just that they don't have the information yet. That's what we call the timing difference, the classical example being outstanding checks. But even if you don't have checks these days and you do electronic transfers, if you're using a full service accrual system, you're still possibly going to have timing differences. They're just going to be less extreme, 3 days or so, instead of, for example, months possibly, if you actually mail out a check to some people that don't cash the check quite quickly and so on. So now we're going to have to compensate for that, and we're going to have to record that on our end, remembering that if you're using QuickBooks or some kind of accounting software, you typically have to do the transaction before you can complete the process of reconciling. A little bit different than a book problem, in which case we often have a 2-sided page where we're comparing and contrasting what we might consider errors or something wrong on the book side to something wrong on the bank side. So let's compare and contrast those. We'll continue to do that here. Let's go back to the month 1, and we're going to go all the way to the right where we've been working on our bank reconciliation for the first month of operations. All right, so here's the bank rec. So we had our general ledger. We entered the general ledger, and then we checked off all the stuff on the general ledger that was on our bank statement. So all the colored ones were checked off. The non-colored ones, or the ones that are remaining blue, are the ones not checked off, meaning they're on our books, but they're not on the bank statement. We're going to assume that those are okay for now, and those will be the reconciling items, the things we know about that the bank does not yet know about. And then we have these 2 items that, again, were on the bank statement but not on our books. And then we have this beginning balance issue, which we talked about as well, that basically nets out against each other given the circumstances that we're looking at here. So now we took this information. We have the cleared balance worksheet, which is basically the reconciling worksheet that you might see in like a QuickBooks or a Xero, taking the beginning balance and then checking off all the things that have cleared the bank. So you might call this, this is the cleared balance, the stuff that matches the bank. So we should be able to get the difference down to 0. It's not at 0 right now, which means that if you did this in a QuickBooks or a Xero software, it wouldn't let you reconcile unless you forced it to reconcile by telling the system to record a plug, to record a journal entry, which you don't typically want to do. You want to get it to reconcile exactly, because if you don't, that lowers the internal control of the bank reconciliation greatly, a lot. All right. So then we did like a book type of bank reconciliation. So if you do a book problem, you will typically have the book side and then the bank side. And every difference we're going to look at, and we're going to say, is it kind of an error or something that's not known on the book side or the bank side? Which side needs to be adjusted? So anything that's on the bank statement in this kind of scenario that's not on our books would need to be adjusted to our books. So again, we're going to have to fix that with an actual adjustment. But before we do that in a book problem, we usually just write it down, right? So we're going to say, okay, there was the 88811 was our book balance. And then we had 150 and 15 that are on the bank statement, which is not on our books. We're going to have to add that to our books. Once we do that, that's going to bring our book balance down to 88646. On the bank side of things, this is the bank balance, which was the ending balance as of the same time, 61242 about. We're using rounding here. And these are the outstanding checks, the ones that we were not able to check off. So these checks we're going to assume are good, and deposits, checks and deposits, we're assuming they are good. We knew about them. The bank just doesn't know about them. They're just timing differences. That's typically the assumption. So you can imagine that in a QuickBooks system, all we have to do is figure this bit out, and the system will take all the stuff that we did not check off and make the reconciliation. And that's what we're doing here. So these are all the ones we didn't check off on the decreases. And this is the deposit we didn't check off. And now we have the adjusted bank balance at the 88646. So now what we want to do is make the adjustment for these two. And once we do that, then our book balance will actually be 88646. Meaning we're going to eliminate this half of the bank reconciliation. We're just going to fix it. We're going to fix it so that this will be the balance, and therefore we'll be left with just a bank reconciliation, which will in essence be this side of things. So let's see what that will look like. So I'm going to say so to do that, I have to then look at what the two transactions that were recorded over here that we need to basically record, the 150 withdrawal and the bank services. Now the 150 we're going to imagine they just took money out of the bank. So if you're a bookkeeper and you're working with clients, what we would like to be setting up, just as a general rule, if we're doing our own books, it's the same, is that anything that's a legitimate business expense, I want an audit trail. The audit trail is good. And if you think about it from an income tax perspective, as we have in the United States, at least, why is the audit trail good? Because I want to prove that I paid for something, So if I paid for it with cash, I don't have the audit trail. But if I paid for it with an electronic transfer or a check or something like that, a credit card, then I have the audit trail, which is good because the deductions for income tax purposes are good. And if the IRS comes and basically questions my deductions, I want the audit trail to say, hey, look, here's the transactions. It cleared the bank and it went through the credit card and so on and so forth. So what we don't want to do is pull cash out and pay for things because we don't have an audit trail there unless you basically keep all the receipts, which used to be something we had to deal with a lot more when people favored cash transactions a lot more. So then we had to support our transactions by uploading receipts and things like that, which is a very tedious thing to do. We would like the support to be automated for the legitimate business expenses. So that would be so then we would like then to say, hey, look, if you're going to take money out of the business, I would like to assume that it is only going to be a draw. Because when you want personal stuff, when you want to take the money out of the business and use it for your personal whatever, then obviously maybe you don't want an audit trail on that. You don't want, maybe you just want to spend cash on that. That's fine. But we want to pull it out of the business first and then spend the cash on it. In other words, if you have a client or yourself that is pulling cash out of the business and spending cash for expenses, it becomes difficult to track because I can't get that information from the bank statement because there's no audit trail except for the fact that you drew the cash out and there's no place where it's actually going. So that's just something to basically keep in mind. Now, if someone pulls out the 150 and they say, oh, I spent that for business expenses, then the question is going to be, well, where do you want me to put it? What business expense did you buy? Supplies? Should I put it right? And you're going to dump it into some kind of expense account. So we're going to assume in this case that that's what they say. We bought supplies with it or we bought miscellaneous expenses and we'll put it into there. And then next month, we'll do what we hope to be happening every time we see a withdrawal. And that is they took the money out for their personal use, put it in their personal bank account, and then they can spend it out of that account however they choose to spend it or spend the cash and so on. And maybe the audit trail is not so important. Although on personal budgeting, it's also nice, to have the audit trail. Cash is usually used when people maybe don't want an audit trail these days, or it used to be cash was kind of an easier thing to spend. And a lot of people liked cash transactions and still do, because maybe you avoid things like credit card charges, right? Maybe you can give someone a tip where they actually get to keep the money and they don't have to avoid some taxes maybe, or maybe not have to put it in the pool. You can actually give someone who you want to give the tip to that person to give them the tip if you give them a cash tip. So cash is still great, still good things for it. But sometimes it's great to have the audit trail. So the question is, when do we want the audit trail? And of course, if we're doing bookkeeping, especially for someone else, we want to have the audit trail because that's what we're using to build the books. Oftentimes getting that information directly from the bank, which if we use electronic transfers, we're going to have a lot more information to build the books from. Anyways, let's go back on over here and say that we're going to go all the way to the left. And let's record this thing. I'm going to scroll up top and freeze the panes. Let's freeze it right here. I'm going to put my cursor on A5 and go to the View tab and freeze the panes. Scrolling down. And then we're going to say this is going to happen. Now, I'm going to record this transaction as of the end of, what did I do? Okay, pause. So this is going to be 131. And then I'm going to record it as of the end of last month because we're doing the bank reconciliation for the first month of operations. So I'm going to call this miscellaneous expense for cash draw. And that was, I'll just type it in here. That was the 150 that came out, right? So that was the 150. And so they just told, notice I had to ask the client, or I had to think about it myself. And there's like, oh, it was a business expense. What did you buy? Do you have a receipt? No, just expense it somewhere. Okay, well, we don't have much choice. We're gonna have to put it into miscellaneous expense. Now, obviously from a tax perspective, it's a deduction. And if you have miscellaneous expenses that are a lot, then the IRS is likely to audit you possibly, or, you know, that's a red flag at the least. and then when you say that you have all this stuff, the only audit trail you're going to have is, well, I took cash out of the bank, and they're going to ask, well, where are the receipts, right? And then you got to deal with the receipts, and that's a pain. We don't want to. You could upload the receipts to a lot of software like a QuickBooks now too, but why? Just do an electronic transfer. You're making it difficult if it's a legitimate expense. Let me see the trail. You don't need to hide anything here. All right, and then the other side's going to decrease the 150. We're going to put zeros across the board. Zeros across the board. Zeros across the board. And we're going to put an underline here, selecting the whole thing so we can give it an underline. Home tab, font group underline. And then we'll pull down the balance. Let's make sure it's in balance thus far. We'll take this. I'm going to copy this down 2 cells so it's in balance. Cash went down. The other side decreasing. Equity equals the sum, my voice cracked, of the last balance plus the current activity, which is going to be a subtraction because it's a negative number. We're going to copy that, Control C, and then I'm holding down Shift and hitting the right arrow, going to paste it all the way across, right clicking and pasting it, just the formulae. So there we have it. I'll copy down for formatting's sake the signs here, so we don't have that underline, the ugly underline on the sign and that thing. So that keeps us back in balance. And then the other one was on 131. We're going to say we had to pay the bank service charges. So we didn't know about the bank service charges until we, of course, got the bank statement, because they just took it right out of our checking account. Now, if you had electronic transfers for bank feeds, you would have seen them, because the bank feeds would tell you that they had an electronic transfer. So the bank feeds do make some things kind of easier, but remember, it doesn't replace the need for the internal control of the reconciliation. I won't go into that again. Just be aware of that. It might be easier. That would be great, but it doesn't go away. Okay? It doesn't go away. It's still, you still have to do it. Hopefully it'll be an easy thing to do, much easier than the way we're doing it here, but it's still a thing. It has not gone the way of the dodo, that being dead. I'm gonna make a new account for bank service charges. So I'm gonna select the column AL, right click and insert. And then we're gonna say this is gonna be bank service charges. I'll make this a little bit larger. Boop. So we can say I double clicked on it to make it large. All right, what line am I on? Now I forgot the line right underneath, right here. So boom, and then this is going to be a negative because we're going to decrease for an expense, the equity of 15. Let's bring the zeros down, or zeros across the board. Zeros across the board. Zero. Oh, Control Z. It's okay. You deleted it. No. Okay, then I'm going to underline this whole thing. I'm going to underline it. Home tab, font group, underline. And then we'll bring down the balance. Bring down the balance. Oh, wait. Bring down the balance. This equals the SUM control 9 or shift 9 prior balance current activity. Control C will select shift right arrow to the end, right click on it and paste it formulae only. Formulae. And then we'll pull down these for formatting's sake. And then we'll scroll to the left and we'll pull this bad doggy down. And so then so now that brought down the assets and equity. So that's good. So now our cash balance is at the 95,780. 95,780. Let's go back to our bank reconciliation. I'm going to go all the way to the top, all the way to the right. 95,780. All the way to the right. So where were we? Okay, so now, okay, what happened here? Obviously, it's not at 95,780 because we recorded that as of the end of January, and we did 2 months of operation. Let's go back and check it out. Again, let's just analyze this for a second. So now, notice we put this in here as of 131. In our two-dimensional kind of system here, I can't really backdate that easily. If I used, once again, a three-dimensional like a QuickBooks or something, and I put the date in as of the prior month, got to be careful about doing that, but it would allow the general ledger to resort so that would be up where the month one information was. So let's just pull out the trusty calculator here for a second. Calculator, where are you? Boom. So if I look at the month one tab, we were at the end of month one, 88811, and then minus what we did here. Now we put these in there at the end of month one. So as of the end of month one, if I say minus 150 minus 15, that's going to give us our 88646. Let's go back up and scroll over. So that's what our GL balance is now as of the cutoff date or end of month number 1, January. So that then is what we came to here, 88646. So see, we just fixed it now. So what I'm going to do then is just copy this over to the adjusted bank reconciliation. So how do I want to do this? Let's just format this. I'll just take this whole thing. Let's take it from here to here, from here to here. And then I'm going to format it. Home tab, clipboard, let's just format that whole thing and paste the formatting here. And then I'll just recreate this. I'll just say this is going to be equal the balance. And this is, now wait a second. Did it format it? It didn't do it. Okay, I'm going to go to the view tab. I'm going to unfreeze the panes. And then I'm going to select this whole bit. And then home tab, format. So I had to sneeze there for a second. Then I have to select the cells. 1, 2, 3, 4, 5, 6, 7, 8. So 1, 2, 3, 4, 5, 6. 1, 2, 3, 4, 5, 6, 7, 8. Boom. All right, that's more like it. That's better. All right. So now what I'm going to do is this is just going to be this plus this or minus this. So it's just going to be the ending balance now. In other words, we have fixed this so there are no more adjustments. If I just copy this down just to show, this should be double indented for formatting's sake. Zeros, so those are zeros, equals the sum of these, and the adjusted book balance is now, it is what it is. The GL just shows that. That's what would be on the balance sheet. Now it's properly recorded as its adjusted balance after we did the adjusting entries for the bank reconciliation, and the bank side is basically the same. Maybe I could just say we could just compare this to this. I don't even need this bit. So I'll just delete this. So now the book balance, this is now the bank reconciliation, right? This is the bank balance. Here's the adjustments to get us to the adjusted bank balance, which equals book balance, right? And so, and we just fixed the book side of things. So that's the idea. That's the general idea. Hopefully that makes sense. It's a lot easier to do in like a QuickBooks because of the little widget thing, but a lot of people don't really have an idea of what they're doing, even though they're pretty good at doing it, which is fun, which is, you know, that's better than not doing it, right? They know how to do it, but they probably, maybe a lot of people don't know exactly what a reconciliation even means. They just know that they need to do the reconciliating process, which again, still gives a lot of internal controls. But if you know why you're doing it, it's good. And it's a big point of confusion, especially as technology changes in terms of how does the bank reconciliation fit into the accounting process? Has it gone away? What is it actually doing if you use bank feeds and whatnot and so on? So it's good exercise to understand because it hasn't gone away and it's still important.